currently, Bitcoin's not trading at levels using that metric and similar metrics that indicate a high likelihood of a multi-year correction. Instead, it still looks fairly mid-cycle. It still looks fairly conservative in terms of overall euphoria around the asset, at least the quantitative things I look at. And so I think that the majority of indicators suggest that this cycle still has room to go. So I'm generally bullish with, say, an 18-month view. But I would expect turbulence along the way. And if we have any sort of sharp contraction in liquidity, like we saw recently with some of these tariff announcements, kind of spiking dollar and sell-offs in risk assets, that's when you could see some turbulence in Bitcoin.
One of the key frameworks Alden uses to analyze Bitcoin is its correlation with global liquidity. Historically, Bitcoin has followed liquidity cycles, with price movements aligning closely with periods of expanding and contracting liquidity. Currently, liquidity is in a flattish phase, meaning Bitcoin is in a consolidation period rather than a strong uptrend or downtrend. Alden notes that Bitcoin's price hovering around $100,000, moving above and below this level, is consistent with the current liquidity environment. She highlights that if liquidity contracts sharply, Bitcoin could experience turbulence. Conversely, if liquidity expands, it could propel Bitcoin to new highs. This is particularly relevant given recent policy shifts such as tariffs affecting the dollar and risk assets.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
And there's a couple different lenses that I look at Bitcoin through. So one is that tight correlation with liquidity. And so right now liquidity is kind of flattish. Bitcoin's been chopping along at 100K, above and below, kind of in a consolidation. And so that's making sense to me. I also look at Bitcoin through the lens of regulatory clarity. So there's a lot of companies that wouldn't touch it, but then once it got a spot ETF and once you have a Trump administration election, they shifted their views on the acceptability of the asset from a tail risk perspective. And then in addition, I look at on-chain indicators. So mainly what I look for is not to use them as trading per se, but to look for major risks. So in years like 2021, 2017, and certain other years, there were on-chain metrics that showed a high degree of euphoria. So my favorite is market value compared to on-chain cost basis. And when that ratio gets really high, there's a risk of a multi-year correction. And currently, Bitcoin's not trading at levels using that metric and similar metrics that indicate a high likelihood of a multi-year correction. Instead, it still looks fairly mid-cycle. It still looks fairly conservative in terms of overall euphoria around the asset, at least the quantitative things I look at. And so I think that the majority of indicators suggest that this cycle still has room to go. So I'm generally bullish with, say, an 18-month view. But I would expect turbulence along the way. And if we have any sort of sharp contraction in liquidity, like we saw recently with some of these tariff announcements, kind of spiking dollar and sell-offs in risk assets, that's when you could see some turbulence in Bitcoin. So that would depend, I think, significantly on how much they end up buying. And so, the U.S. has gold. It's not audited, but they have it supposedly. Merely not selling it has an impact on the price. If they were to buy more, that'd be bullish for the price. Bitcoin's a smaller asset, so one government can move the asset price more. Like this past year, MicroStrategy has been a pretty big driver of Bitcoin by being such a large purchaser. For example, if you were to see Uncle Sam become a big purchaser, like something along like the Lummis bill, for example, that would be massive for price. Whereas if they merely say, hey, we have existing Bitcoin from various seizures, and that with the exception of maybe some seizures that we're going to give back to the rightful owners, we're going to ring fence the assets we already have
just sort of eminent domain. They're ours now. Yeah.
Yeah, they're ours now, and we're going to call this, we're not going to sell it back to the market. We're going to actually just going to keep this for strategic purposes, and maybe we're not going to add a lot to it. That I think would generally not have a lot of impact on price because it's already kind of priced in. It's already part of that. So I think it would take a fairly large announcement of purchasing these types of assets to really move the price, versus just the optical thing of, hey, the U.S. is officially going to continue holding Bitcoin rather than selling. We've generally seen this in the corporate space, which is that MicroStrategy kind of paved the way. We saw fairly small follow through with that from other corporations in the cycle that they did it. So in the whole kind of past 4-year period, we didn't see a lot of other corporations hop on board, or if they did it in a fairly small way. Whereas now, because there's been accounting changes, and because they see the positive example of MicroStrategy get through a full cycle and come out strong, there has been now a more recent flurry of corporations putting it on their balance sheet. Generally, most entities tend to be followers. There's a lot of career risk in being first and wrong rather than following something with a clear precedent. And countries are very similar. So if they see both positive examples on the small scale, so the El Salvadors or the Kingdom of Bhutan, right? These are entities that have had very good fortunes with, having a long-term goal of stacking Bitcoin on the sovereign level, and getting benefits from that and getting benefits from tourism around that. That can appeal to other nations. And then in addition, if the U.S. Is officially kind of saying, hey, we're maybe not going to buy a ton, but we're just officially going to hold Bitcoin. We think Bitcoin's a valuable thing to have a stockpile in, and so we're going to keep what we have. That does legitimize it in the view of many other sovereign wealth fund holders or reserve asset managers. So I do think it could be less career risk for larger and larger pools of capital to say, hey, we think having a non-zero Bitcoin position is prudent. Basement is likely going to continue, and a lot of it is fiscally driven. Now that does have implications for assets, so that's generally why I like to be, I err toward equities over bonds, and I err toward Bitcoin over many other assets. So it has implications for those fairly scarce types of assets, but the phrase itself is not directly about those assets. It's at least the way I use it, it's about the deficits themselves.
Alden highlights that macroeconomic conditions have been relatively stable since the regional banking crisis in early 2023. However, with new policy changes, increasing fiscal deficits, and currency fluctuations, volatility is making a comeback. One major factor she identifies is the U.S. Treasury's approach to liquidity management. Over the past 2 years, the Treasury has offset Federal Reserve tightening by issuing more short-term debt, T-bills, effectively injecting liquidity into the system. This has helped sustain asset prices despite the Fed's quantitative tightening. However, future liquidity conditions remain uncertain, with potential shifts in Treasury policy and Fed actions impacting Bitcoin and other assets.
So when we did a liquidity analysis on different assets, gold was somewhat mixed in terms of how much it correlates with liquidity, and a big component of liquidity is that dollar strength. And that's because when there's good liquidity, generally, and that often includes a weaker dollar, generally speaking, investors flock to risk assets, so equities, Bitcoin, that type of thing. Whereas when there's reason to be concerned, either because liquidity is bad or for other reasons, investors generally flock to bonds and gold. And so gold kind of got this mixed bag where on the one hand it does benefit from debasement and a weaker dollar. On the other hand, it does also benefit from people coming to defensiveness while the dollar's strong and liquidity is not great. So I do think that can give you a second leg. I think it would partially come to how well are big U.S. stocks doing, right? Because if investors say, well, if we're weakening the dollar and Bitcoin's going vertical and equities are going vertical again, then maybe I just want to be in there rather than gold. Whereas if you have more of that stagflationary environment where maybe, tariffs put prices up, and so maybe you get slowing growth, and you get squeezing margins, and then you get a weaker dollar. That could be an environment where, say, gold outperforms equities. So I would generally need more information to know what to expect in that environment. But I do think that's one of the potential tailwinds for breaching above 3,000 or otherwise getting higher than we currently are. I think I would sum it up with volatility is back. I kind of viewed macro as somewhat boring over the past 2 years or so. I think ever since we had the regional bank crisis in early 2023, and that fire was put out, we've been in a fairly linear stretch of macro. Doesn't mean that there's nothing that's happening, but that things have generally been on roughly autopilot for about 2 years. And with the new administration and kind of the rapid flurry of kind of executive orders and other presidential actions, we're back in a period of uncertainty, higher volatility between currency pairs. And then, of course, that has implications for asset prices. So I think the main thing is that uncertainty is dialed up. Things can change. Like you can have a much bigger position change in, say, a given month in this new environment than it would make sense to have over the past year or two, where trends generally just kept going in a certain direction. General asset prices, where a lot of them were kind of on autopilot, but also just background liquidity effects, kind of trends that were continuing from one quarter to another without major like rapid changes. Whereas now, in the first half of this year, we're already looking at obviously policy shakeups, but then also we could have liquidity pivots and things like that later this year as well. So I think that there's a number of things that kind of represent trend shifts that we're currently going through. And I think that's part of why I refer to the last 2 years as kind of boring in macro, because we've had a fairly stable and helpful liquidity environment. So if you go back 3 years to 2022, there were many of us that were bearish at the time because we had Fed tightening, we had fiscal tightening, kind of all occurring together, and we had purchasing manager indices rolling over, various economic indicators rolling over, high price of oil, all sorts of factors. And what really kind of changed is that by the end of the year, and especially in early 2023, we started to see the Treasury offset some of the Fed's liquidity drain. So the Fed was still doing quantitative tightening, was still holding rates high, but the Treasury began issuing more of its debt as T-bills, which are cash-like. It's closer to money printing than issuing at the long end of the curve. And specifically, like you pointed out, they had over $2 trillion in the reverse repo facility. We can think of that as extra QE. They did so much QE that banks, just because of their kind of regulations, they can only actually hold so much deposits. They can only hold so much liquidity. It's kind of like a cup. If you pour enough in, eventually you reach the brim and no more liquidity will fit in there. And so liquidity spilled out into the reverse repo facility. And so that's all like a pool of extra liquidity if you can get it out. And one of the easiest ways to get it out, issue a ton of T-bills. And then money market funds start buying those T-bills and pulling that money out of reverse repos and back into the banking system. And so for like 2 years, the Treasury's been accommodated for liquidity by issuing more at the front end of the curve and pulling money from reverse repos back into the system while the Fed's doing QT. And especially, from the regional banking crisis and onwards, we've been in this kind of fairly offsetting liquidity environment.
Alden emphasizes that Bitcoin's trajectory will be shaped by a combination of liquidity trends, regulatory developments, and macroeconomic shifts. While she remains bullish on Bitcoin over an 18-month horizon, she expects turbulence along the way. Sharp liquidity contractions, geopolitical events, or unexpected policy shifts could create short-term headwinds. Nonetheless, with increasing corporate adoption, potential sovereign interest, and the continued expansion of the Bitcoin ecosystem, the long-term outlook remains strong. As institutional capital flows into Bitcoin and more entities recognize its value as a scarce digital asset, its role in the global financial system is poised to grow.